An airport in Iran has just been struck by the United States military. Within hours, oil traders 3,000 miles away in Riyadh were on the phone before they were at their desks. That sequence, a bomb falling and a market reacting faster than a government can issue a statement, is the entire story. Everything else is commentary. Here's what almost nobody is telling you this morning. This strike is not really about the airport. It is not really about Iran's air defense. It is about a number that has been climbing for 5 months, that crossed $100 a barrel this week for the first time since May, and that every strike, every blockade, every retaliatory missile is now feeding. The mainstream coverage will show you a burning runway and call it a military story. It is not a military story. It is a supply chain story wearing a military uniform. So the question worth asking is not, why did the US bomb this airport? The question is, what happens to the global economy when the two arteries that move a quarter of the world's oil, onto the Strait of Hormuz and now the Bab al-Mandeb, are both under threat at the same time? That has never happened simultaneously before. Not in 1973, not in 1990, not in 2019. It is happening now, and it is happening this week. Stay with me. This is not a news recap. This is the structural anatomy of how energy wars actually work, and why the people telling you this is just Iran being Iran are missing the mechanism entirely. Let's establish the timeline, because the timeline is the argument. This war did not start with an airport strike. It started in February, when US and Israeli forces launched a coordinated campaign against Iranian nuclear and military infrastructure. What followed was not a short punitive operation. It became a rolling, multi-month campaign, with US strikes on Iranian command centers, missile sites, and, critically, Karg Island, the terminal that handles the overwhelming majority of Iran's oil exports. When a president stands up and says a target has been totally obliterated, that is not just a military claim. That is a message to every trading desk on Earth. Iranian barrels are coming off the market, indefinitely. Iran's response was not to sue for peace. It was to make the Strait of Hormuz, the 21-mile choke point through which roughly a fifth of the world's oil and a fifth of its liquefied natural gas physically passes, unusable. Mines, boarded vessels, warnings to shipping companies, a tugboat sunk, more than a dozen merchant ships damaged, sailors killed. The mechanism here is simple and old. If you cannot match your adversary's air power, you attack the infrastructure their economy depends on instead. You don't need to win a war. You need to make the cost of shipping higher than the value of the cargo. That's the first structural law at play here. Choke point economics. A choke point doesn't need to be closed to be effective. It needs to be uncertain. Insurance premiums on tanker transits through Hormuz didn't wait for an actual sinking to spike. They moved on the threat of mines. That's the mechanism the mainstream footage never shows you. The war is being fought as much in Lloyd's of London reinsurance pricing as it is in the Gulf. Now overlay the second law. Escalation has a floor, not a ceiling. Once the United States imposed a naval blockade on Iranian ports, cutting off Tehran's own oil exports as a war measure, there was no rational off-ramp left for Iran that didn't involve retaliation. A blockaded state with a war economy has one lever: make the blockade cost the blockader more than it costs you. That's why you saw strikes reach U.S. regional allies, Jordan, Kuwait, Bahrain. That's why a ceasefire brokered in the summer collapsed within days. Ceasefires struck without addressing the underlying choke point dynamics don't hold, because neither side has actually removed the other's ability to escalate. They just paused. And now the third structural piece, the one that turns a regional war into a global economic event, the Houthi variable. Yemen's Houthi movement, backed by Tehran but not directly commanded by it, has its own grievances and its own leverage. Control, or at least disruption capacity, over the Bab al-Mandeb Strait and the Red Sea shipping lane. When Hormuz became unreliable, Saudi Arabia's alternative was a pipeline route to the Red Sea. The Houthis' answer to that was to announce a blockade of their own against Saudi shipping, in specific retaliation for a strike on Sanaa's airport they blame on Riyadh. Do you see the shape of it now? This is not two countries fighting. This is a double choke point failure. Hormuz compromised by a direct US-Iran war. Bab al-Mandeb compromised by a third actor, using the chaos to settle its own scores. Saudi Arabia, the country every energy model on Earth treats as the swing producer, the reliable buffer, is now boxed in on both of its export routes at once. That has not happened before. Not during the Yom Kippur War, not during the Gulf War, not during the tanker attacks of 2019. This is a new configuration, and oil breaking $100 a barrel this week is not a spike. It is the market pricing and the fact that there is currently no reliable route out of the Persian Gulf that doesn't pass through a war zone. Consider what that means structurally for a moment, because the number itself is less important than what produces it. Oil prices are not set primarily by how much crude exists in the ground. They are set by how confident a buyer is that the barrel they purchase today will arrive at its destination on schedule, uninsured against catastrophic loss, and unimpeded by a navy that might decide to interdict it tomorrow. That confidence is the actual commodity being traded in a crisis like this one. Strip it away, and the physical volume of oil in the world becomes almost irrelevant to the price. What matters is the probability distribution of it reaching a refinery intact. This is why gasoline in the United States climbed toward $4 a gallon, even though American refineries were never directly threatened. The domestic price isn't set in isolation. It's set on a global benchmark, Brent crude, that reflects the entire system's risk, not just the risk to any one leg of the supply chain. A mine laid in the Strait of Hormuz raises the price of gasoline in Ohio just as surely as a refinery fire in Texas would, because the market treats global crude as a single fungible pool with a single risk premium layered on top, and that risk premium compounds. Every additional week the conflict runs, reinsurers reprice Gulf transits upward again. Every repricing makes the voyage more expensive, regardless of whether a single additional ship is ever actually hit. This is the mechanism most viewers never see explained. The war doesn't need to sink tankers to extract a toll from the global economy. It only needs to make sinking tankers plausible. The toll is collected in advance continuously by an insurance and shipping market that prices probability, not certainty. The official narrative says this is a war about Iranian nuclear capability and regional terror proxies. That's the surface. The deeper reality is a fight over who gets to price the world's most important commodity. Here's the counterintuitive fact almost nobody puts on screen. The United States doesn't need Persian Gulf oil anymore. And that is exactly why it can afford to let this war run long. For 50 years, American strategy in the Gulf was built on a single imperative. Keep the oil flowing, because American cars, when American Gulf and the American dollar's global role were downstream of that flow. That's the old petrodollar logic. Oil sold in dollars, recycled into U.S. treasuries, dollar demand locked in by energy dependence. Under that old logic, a war that shuts Hormuz would have been unthinkable for Washington to tolerate for even a week, because American gas prices and American financial credibility were both hostage to the strait staying open. That calculus has changed. U.S. domestic shale production altered the equation years ago. America is a net energy exporter in a way it wasn't in 1973 or 1990, which means a war that spikes global oil prices no longer threatens American energy security in the way it once did. It threatens everyone else's energy security, while U.S. producers capture the upside of higher prices. Gasoline at $4 a gallon domestically is a political problem for an administration ahead of midterms. It is not an existential one. That distinction matters enormously because it changes what victory looks like from Washington's perspective. This is where you have to separate the rhetoric from the incentive structure. The rhetoric says the strikes are about degrading Iran's capacity to threaten shipping. The incentive structure says a prolonged conflict that keeps Iranian oil off the market, keeps Gulf risk premiums elevated, and forces global buyers to bid up non-sanctioned barrels is not a cost the U.S. energy sector is desperate to see end quickly. Higher global prices with domestic production insulated from the disruption is not a crisis for American energy producers. It's a windfall. Now flip to Iran's side of the ledger, because the counterintuitive read cuts both ways. Iran cannot win a symmetric air war against the United States. That was obvious from week one. What Iran can do is make itself so costly to fight that the political will to sustain the campaign erodes before Iran's capacity to resist does. That's not a new Iranian strategy. It's the same logic Iran has used with proxies for 2 decades. You don't need to defeat a superpower's military. You need to outlast its domestic patience. A rolling campaign that produces dead American soldiers, downed aircraft, and a domestic gas price crisis ahead of an election is precisely the kind of pressure built to test that patience. So here's the secret most coverage buries under footage of explosions. Both sides are playing a war of attrition against a clock that isn't military, it's political and financial. Washington is betting Iran's economy and military infrastructure collapse before American voters' patience does. Tehran is betting the reverse, that oil prices and casualty counts erode Washington's appetite before Iran's capacity to keep disrupting shipping runs out. Saudi Arabia, trapped in the middle with both its export routes compromised, isn't fighting this war at all. It's absorbing the cost of a fight between 2 other parties, which is the oldest and cruelest position in Gulf geopolitics. The swing producer becomes the shock absorber. There's a second counterintuitive layer worth surfacing here, and it concerns the dollar itself. For half a century, the petrodollar system rested on a simple bargain. Oil-producing states sell crude in dollars, and in return, the world's dominant military power guarantees the sea lanes those dollars depend on stay open. That bargain assumed the guarantor and the disruptor could never be the same actor pushing prices in the same direction. What's unusual about this conflict is that U.S. military action is itself now a primary driver of the very price volatility the old was built to prevent. Washington is simultaneously the guarantor of global shipping lanes and, through its own strikes, a contributor to the instability making those lanes unsafe. That's not a contradiction anyone planned. It's an emergent property of a war where the strategic logic of degrade the adversary's oil infrastructure collided with the strategic logic of protect global oil infrastructure. And those two mandates turned out to be harder to hold simultaneously than anyone in Washington's war planning rooms likely expected in February. Watch how this plays out in the behavior of countries that are nominally neutral. India and China, the two largest buyers of discounted Iranian and Russian crude over the past several years, have every incentive to keep purchasing barrels outside the sanctioned, insured, Western-aligned shipping system, because those barrels come with a built-in discount that widens every time Gulf risk. Premiums rise. That's a quiet, second-order consequence almost nobody puts in a headline. A prolonged Hormuz crisis doesn't just raise prices, it strengthens the economic logic of a parallel, sanctions-resistant oil trade network that bypasses Western insurers, Western shipping registries, and ultimately Western financial oversight entirely. Every month this war continues is a month that's the structural reality underneath a headline about a bombed airport. It was never really about the airport. The airport is a data point in a much larger contest over who controls energy pricing risk for the next decade, and, quietly, over which financial architecture the next decade of oil trade gets settled in. Let's walk the board move by move, because this is where most analysis gets lazy and just says, it's complicated. It isn't complicated, it's sequential. Move 1. The United States degrades Iran's export capacity. Strikes on Karg Island were not incidental. That terminal is the single point of failure for the overwhelming majority of Iran's oil revenue. Take it offline, and you don't just damage infrastructure, you damage the regime's ability to fund the war it's now fighting. This is classic economic warfare wearing a military uniform. Countermove. Iran degrades everyone else's export capacity. If Tehran cannot sell its own oil, the rational response is to make sure nobody else can reliably sell theirs either. Hence Hormuz. This is the if I can't have it, no one can logic of asymmetric warfare. And it is devastatingly effective against a choke point economy, because the cost of disruption is a fraction of the cost of defense. Mining a strait is cheap. Guaranteeing safe passage through it for every tanker, every day, indefinitely, is extraordinarily expensive. The economics of choke point denial always favor the disruptor. There's a nuance in Move 1 that most coverage flattens entirely. Degrading export infrastructure and degrading military capability are not the same operation, even when the footage looks identical. A strike on a radar installation buys you hours or days of tactical advantage. A strike on an oil terminal buys you months of economic advantage, because rebuilding export infrastructure at scale, pipelines, pumping stations, loading terminals capable of handling supertankers, is not something you improvise under active bombing. That distinction is why Karg Island mattered more than any single air defense site destroyed in this campaign. Air defenses can be dispersed and reconstituted. A national oil export terminal cannot. Move 2. The U.S. imposes a naval blockade on Iranian ports. This escalates from degrading Iran's ability to export to actively preventing it, which removes any remaining incentive for Tehran to negotiate a quick de-escalation, because the blockade itself has already imposed the maximum economic pain available short of regime collapse. There is no good behavior discount left to offer Iran. The punishment is already at its ceiling. Countermove. Iran spreads the cost regionally. Strikes against U.S. partner nation infrastructure, Jordan, Kuwait, Bahrain, are a signal that if Iran's economy is going to be collateral damage in a war, it didn't choose the terms of the economic and political cost of hosting American forces will be shared by every country in the neighborhood. This is a pressure campaign aimed not at Washington directly, but at Washington's regional coalition. Because a coalition that starts absorbing casualties and strikes on its own soil starts asking its own domestic audiences why it's still hosting American forces at all. Move 3, the wild card. The Houthis open a second front. This is the move that should worry serious analysts more than anything the US or Iran has done directly, because it's not fully controllable by either side. The Houthis have their own grievance, the Sana'a airport strike, and their own leverage over Bab al-Mandeb. When they announce a blockade against Saudi Arabia, they are not following Tehran's orders on a leash. They are exploiting a moment of maximum regional chaos to pursue their own agenda, which happens to align with Iran's interests without being controlled by Iran. That's the nature of proxy and aligned actor warfare. Once you've destabilized a region enough, other actors with their own scores to settle start moving pieces on the same board, and nobody, including Tehran, has a clean way to call them off. Now, the fatal error. Every side in this conflict has won, and identifying it is the actual value of an insider, read versus a headline recap. Washington's fatal error, if it's making one, treating Gulf energy security as someone else's problem now that American shale insulates domestic prices. That calculus is true right up until it isn't. A war that pushes oil past $100 a barrel doesn't stay contained to gas station prices. It feeds into shipping costs, into global inflation, into the cost of literally everything manufactured or moved by sea. A White House betting that domestic energy independence buys it, strategic patience is betting against the fact that America's economy, even if not its fuel supply, remains deeply embedded in a globally priced energy market. Insulation from the supply shock is not insulation from the price shock. Iran's fatal error, betting that attrition warfare against American patience works the same way it has against smaller regional adversaries. It doesn't, because the actor being worn down this time isn't a regional government with a shaky coalition. It's a superpower with a resourced military and, crucially, a domestic energy sector that benefits, at least in the short term, from exactly the kind of price volatility this war is producing. Iran may be betting on an opponent's fatigue that structurally has less reason to fatigue than past adversaries did. Saudi Arabia's fatal error, strategic passivity. Riyadh has, so far, absorbed strikes and route disruptions without a proportionate response. Of its own, betting that staying out of direct retaliation preserves its position as the indispensable stable supplier everyone still needs. That's a defensible strategy, right up until both of its export routes are simultaneously compromised, at which point staying out of it stops being a strategy and starts being a description of having no leverage left. A swing producer with no swing capacity isn't a power broker, it's a target. There's a fourth actor on this board that rarely gets its own segment, and that's a mistake, because its behavior may end up mattering more than any single strike. Oman. Muscat has positioned itself as the mediating channel between Washington and Tehran throughout this conflict, hosting the diplomatic track even as the military track continues in parallel. That's not incidental. It reflects a structural truth about how Gulf wars actually terminate. They rarely end through military victory. They end through a face-saving diplomatic architecture that lets both sides claim they achieved their core objective without either admitting defeat. The proposal on the table, splitting Hormuz into separately managed transit lanes, is exactly that kind of face-saving architecture. It doesn't require Iran to admit its blockade failed. It doesn't require the U.S. to admit its military campaign didn't force capitulation. It just quietly re-establishes predictable shipping, which is the only variable the global economy actually needs solved. That's worth sitting with, because it reframes the entire endgame question. This war will not end with a surrender. It will end with an insurance market deciding transit risk has fallen enough to reprice downward, which will happen only after both militaries have extracted whatever domestic political value they can from continuing to look strong. Watch the diplomats in Muscat more closely than you watch the fighter jets. The diplomats are the actual exit ramp. The fighter jets are the negotiating leverage being generated to make that exit ramp usable. One more piece of the counter-move sequence deserves attention. The U.S. response to the tanker strikes near Bandar Abbas, Kish, Keshem, and Abu Musa, a broad, multi-island bombing campaign rather than a single retaliatory strike. That pattern tells you something about targeting philosophy. This is not proportional retaliation for a single provocation. It's systematic degradation of every node Iran could use to reconstitute its coastal strike capability, radar installations, fast attack, boat bases, missile batteries, spread deliberately across multiple islands to complicate any single retaliatory strike. When a military campaign starts targeting redundancy itself rather than any one facility, that's a signal the campaign's planners expect. This conflict to run for months, not days. You don't spend that kind of sustained air power trying to eliminate duplication in an adversary's capabilities unless you're planning for a long fight and want to make sure the adversary can't quietly rebuild capacity between rounds. Strip away the footage of a burning runway, and here's what remains. A war being fought less over territory than over who absorbs the cost of energy uncertainty for the next several years, the producer, the consumer, or the country, caught in between with no good options left. The official narrative will keep calling this a military story about an airport. The structural reality is that the airport strike is a single data point in a 5-month campaign to reshape who controls Gulf energy risk, fought with a logic that has nothing to do with who wins battles and everything to do with who runs out of patience, capital, or alternatives first. Watch what happens to insurance premiums on Gulf shipping over the next 2 weeks, not what happens to the front lines. Watch whether Saudi Arabia finally moves from absorbing this war to responding to it. Watch the Muscat channel more closely than the Pentagon briefing room. And watch whether a $100 barrel of oil becomes the number that finally forces a negotiated end, not because anyone wins, but because at that price, Every party at the table starts losing more by continuing than by stopping. Here is the number to hold on to after this video ends: 25%. That's roughly the share of the world's seaborne oil, trade, and liquefied natural gas that has, for the better part of 5 months now, been running through a corridor two militaries and an armed non-state actor are actively contesting. No modern economy has ever been tested against that scenario running for this long. The 1973 embargo lasted months and reshaped energy policy for a generation. The 1990 Gulf War lasted weeks. This has already outlasted both, with no single choke point fully closed and no single actor fully defeated, which is itself the most unusual feature of this war. It isn't escalating toward a decisive event. It's stabilizing into a permanent elevated risk equilibrium. And markets, unlike militaries, don't wait for equilibria to resolve before they reprice around them. That repricing is already happening in places most viewers never look: shipping insurance syndicates, sovereign wealth fund hedging, positions, central bank commodity reserves, and the slow, almost invisible migration of oil trade settlement toward currencies and clearing systems that don't run through Western financial infrastructure. None of that will appear in tomorrow's headline about the airport. All of it will still be here in 5 years, long after this particular strike is forgotten, quietly having rewritten who holds leverage over the next global energy cycle. That is how energy wars actually end, not with a ceasefire signed in good faith, with a price nobody can afford to keep paying, and a financial architecture rebuilt underneath everyone's notice that nobody can afford to undo.